Hello and welcome to this recording in which we will consider the preparation of flexible budgets. A fixed budget is a planning device. It's prepared in advance of the period to which it relates and is prepared to help the organisation to achieve its objectives. Whereas a flexible budget is a control device. It allows the comparison of actual results to the budgeted results. In order to prepare a flexible budget, a good knowledge of cost behaviour is required. Therefore, you need to be able to recognise fixed costs, variable costs, semi-variable costs, and stepped costs. A flex budget is a budget that has been adjusted to reflect the actual levels of output. Once we have produced a flexible budget, we will compare the actual costs and revenues incurred to the flexed budget. The differences are referred to as variances. Variances are considered to be either adverse, where the actual results are worse than budget, or favourable, where the actual results are better than budget. Once the variances have been calculated, any variances that are considered to be significant are reported to the budget holders and managers. This is referred to as feedback. We also use the information to feed forward so that action can be taken in the future to try and prevent the variances arising again. Significant variances are generally those that are outside of a predetermined control limit. So an organisation may decide that any variances that differ from the budget by 5% or more are significant and therefore should be reported and investigated. Now, the causes of variances can vary, but in general the causes of sales variances will be due to a difference in the budgeted and actual selling price. The causes of material variances due to a difference in the actual and budgeted quantities used and price paid, and labour variances due to the difference in hours worked and the rate of pay. Now, in terms of control action, an organisation needs to know whether the variances are controllable or uncontrollable. If they are controllable, then the organisation can take action to try and eliminate them in the future. If they are uncontrollable, then the budget needs to be adjusted to reflect this. Uncontrollable variances can be those variances that are due to inflation, exchange rates, weather, change in the minimum wage, or some other form of government action. So we are now going to look at an example. This is TT Limited. They manufacture a single product, and the following data shows the actual results for the costs for the month of January compared with the budget. So we have TT Limited operating statement for the month ended 30th of January. The units produced actual were 1,000 units. The budget is for 1,200 units. Now, the information from comparing budget to actual, so the variances, is not of much use currently, since we are not comparing like with like. we are not comparing a budget for 1,000 units with an actual for 1,000 units. Since the budget and actuals are based on different amounts of units produced, we would expect there to be differences in the costs. So what we need to do is prepare a flexed budget. So a flexed budget is a new budget for the actual quantity. So we are going to prepare a new budget for 1,000 units. We can then compare the actuals to the budget and calculate the variances. So in addition to the costs, management have identified that the following budgeted costs are fixed. So the direct labour, £8,400 is fixed. The production overhead, £18,000 fixed. Administration overhead, £21,000 fixed. Selling and distribution overheads, £14,000 is fixed. So the requirement is to prepare a flexed budget, so a budget for 1,000 units, show the actual results and the variances. So step 1 is from the budget we need to identify the fixed costs and the variable costs per unit. So starting with direct material. Direct material is always a variable cost. What we have been told is that it is £19,200 for 1,200 units. Now we need the variable cost per unit. 19,200 divided by 1,200 tells us that the direct material is £16 per unit. The direct material is variable. The second cost we are given is the direct labour, which is £13,200. Now we've been told that 8,400 of that is fixed. So therefore, the rest of it must be variable. So direct labour is a semi-variable cost. £13,200 is the total. If we take away the fixed part, then 4,800 is variable. We need to know the variable cost per unit. So if we now divide the £4,800 by 1,200 units, we get a variable cost of £4 a unit. Next, we look at the production overhead. We are told that 18,000 is fixed. The total figure that is in the budget is 24,000. So the difference must be variable. So again, production overhead is a semi-variable cost. So if we take the total of 24,000 deduct the fixed part of 18,000. That leaves us with 6,000 variable. We need to know the variable cost per unit. So £6,000 divided by 1,200 gives us £5 per unit. The next cost in the budget is the administrator's overhead, £21,000. We've been told that £21,000 is fixed, so the whole of the administration overhead is fixed. So we don't need to do any calculation with that particular cost. And lastly, selling and distribution. We are told that £14,000 is fixed. The total overhead is 16,400, so the difference must be variable. So selling and distribution is a semi-variable cost. 16,400. Take away the fixed part of 14,000. That leaves us with 2,400. 2,400 divided by 1,200, and the administration overhead variable part is £2 per unit. So that is step 1 completed. So from the budget, we've identified the fixed costs and the variable cost per unit. Step 2 is to now use these calculations to prepare a new budget for the actual output of 1,000 units. So if we start with the direct material, we know that our direct material is variable and it is £16 a unit. So if our budget is going to be for 1,000 units, then 1,000 times 16 will give us our new figure for the new budget, £16,000. Direct labour we have identified as semi-variable. There is a fixed part of 8,400 and a variable part of £4 a unit. So for 1,000 units, our labour will be the fixed part of 8,400 and the variable part of 1,000 units times £4. So our budget figure for direct labour will be £12,400. Now we look at the production overhead. Again, we've identified this as a semi-variable cost, which means there is a fixed part and a variable part. we know the fixed part is 18,000 and we know the variable part is £5 a unit. So we can now work out the budgeted figure for 1,000 units. The fixed part, 18,000, and then we have 1,000 units at £5 a unit. So that totals £23,000. The administration overhead is all fixed. So the figure that was in the original budget will also be in the new budget. So that was £21,000. There's no workings to do there. And finally, the selling and distribution overhead. We identified as semi-variable. So there is a fixed element of £14,000 and a variable element of £2 a unit. So if our budget is for 1,000 units, we have the fixed element of £14,000 and the variable part, 1,000 units at £2 a unit. That gives £16,000. So in total, 88,400. So we've done the workings and we have a flexed budget. So we have a new budget which is based on 1,000 units. So the question asked us to prepare a budget, actuals and variances. So if I just transfer our calculations into this table, so our flexed budget, material, labour, production overhead, administration, and selling and distribution, totalling 88,400. In the actual column, we are going to put the actual costs that we were given. Okay, just find those. So that's all of these. So we're just transferring these straight into our statement. Totaling 90,790. The variance is the difference between the two. So the difference in the material, 490. The actual is higher than the budget, so that's worse than expected. So that is adverse. Labour, the difference between the two is £20. We've actually spent less than the budget, so that's better, favourable. The production overhead, the difference is 1,120. Again, the actual exceeds the budget, so we spent more than we planned, so that is adverse. The administration, there is £600 difference, and the actual is more than the budget, so it's adverse. Selling and distribution, there is a £200 difference, and the actual is more than the budget, so we've spent £200 more on overheads than we planned, so that is adverse. And finally, looking at the overall totals, we exceed the budget by £2,390, and that is adverse. So this budget would be used for control purposes. For each of the costs, if the variance was considered significant, it would be reported to the relevant manager or budget holder. They would investigate the cause of the variance and use that information to feed forward to try and prevent those variances arising in the future. This is meaningful information because we are now comparing like with like. What we expected our costs to be for 1,000 units and what they actually were for 1,000 units. If we look back at the original example, the total cost was budgeted to be 93,800, the actual 90,790, giving a £3,000 favourable variance. Now this is because we were not comparing like with like. The actual was 1,000 units and the budget was 1,200. So if we've produced less units than we budgeted for, we would expect our costs to be less. But when we actually flex the budget to 1,000, so that what we are comparing is what do we expect the costs to be for 1,000 units to what they actually were for 1,000 units, we were left with an adverse variance and a number of variances which would need investigation. So this demonstrates the preparation of a flexed budget. So a flexed budget is always a new budget produced for the actual output. In this example, the layout of the new budget has been the same as the original budget. You may be asked to prepare new budgets and present them in an alternative format, such as in a marginal costing layout. So do check carefully as to what you need to do. And that brings us to the end of this recording.